The presentation of Union Budget in India assumes far more significance than any other part of the world. Normally a budget is an account of income and expenditure of the government, but in case of India, it is also used as an opportunity by the Finance Minister to outline the whole economic and policy agenda of the government. This year's budget should be seen in the backdrop of the political situation, economic situation in India and in the rest of the world, and also the fiscal arithmetic. We witnessed 2 days back that hike in passenger fare in the railway budget met with a lot of opposition, and a situation has come where the railway minister may have to resign. So given the compulsions of the coalition politics, the finance minister was not expected to announce some bold measures or to announce measures that could have annoyed some of the coalition partners or opposition, as getting the budget passed would have been his bigger priority. We also have to see the economic reality where the growth has been slowing down in India and the external environment has not been very conducive. So the challenge in front of the finance minister was to move towards fiscal consolidation and at the same time ensuring that growth momentum comes back. At the same time, he announced an increase in indirect taxes, particularly service tax and excise duty across the board from 10% to 12%, which will boost government revenues. On the direct tax side, the overall proposals are not going to result in any kind of revenue loss or gain to the government. We think that meeting the borrowing program next year is going to be a challenging task for Reserve Bank. The budget could also be termed as little inflationary since the overall taxes have been raised and no major measures to augment the supply side has been taken. RBI could be going slow in terms of cutting rates going forward. We were expecting rate cutting cycle to begin from April onwards, but given the fiscal situation and the inflationary outlook, RBI may go a little slow in terms of cutting rates. Though we still expect RBI to cut the repo rate by 25 basis points in April policy, but the fiscal consolidation would weigh on their mind. We expect the bond yields to go up because of the higher borrowing number. In the first 6 months, when government would like to complete 65 to 70% of the overall borrowing program, given the tight liquidity scenario currently, it can put upward pressure on the bond yields. On the positive side, the fiscal arithmetic looks more achievable and realistic. Compared to last year, when the government overshot its borrowing program by a substantial number, this year we believe the government may be able to achieve the fiscal deficit target, though it will surely depend on things like crude oil prices, where increase in crude oil prices could lead to more subsidy bill. It will also depend on the revenue collections, where if the growth is lower than 7.5%, which is projected by the finance minister, if it is lower, then revenue targets may not be met. But broadly, looking at the expenditure and the revenue expectations, the number looks far more achievable and realistic compared to what we witnessed last year. On the other measures, the finance minister tried to address the funding constraints of some of the sectors like airlines and infrastructure. He also announced some other measures to support industries like power generation, infrastructure and airlines. But overall, the budget lacked credible roadmap to boost investment in infrastructure. Maybe some of those announcements might come outside the budget. He also mentioned presentation of couple of legislative bills in the current session of the parliament, and we have to wait and watch the political situation in next couple of weeks, how the parliament session goes and whether some other important reforms can be carried out. As I mentioned at the beginning, that given the current political situation, there was very little scope for him to take very bold measures or take forward reforms which could have met with opposition from other parties, and therefore he tried to make it an event which would be non-controversial, or which would be an event which or could be a budget which would be liked by almost everyone. And I think to a large extent he achieved that purpose. Apart from fiscal consolidation, the other expectation from the budget was to boost the investor sentiment. Measures like high levels of foreign direct investment in sectors like multi-brand retail, aviation, insurance, some of the other measures which could have improved the overall sentiments towards the capital market, but barring few measures like a little bit of reduction in securities transaction tax or some amount of new incentive for retail investors to invest in direct equities, the budget lacked any major measures to boost sentiment for investors investing into the capital market. In terms of sectoral impact on some of the industries, the increase in cess on oil production could impact oil producing companies. There were some measures which could impact cement companies, but by and large there were no major measures in the budget which could significantly impact the profitability of a particular industry or segment of business. But of course we need to keep in mind that increase in excise duty, increase in service tax, and if interest rates do not fall as much as expected, it could impact the profitability of the corporate sector as a whole in case corporates or the businesses are not able to pass on that cost to the consumers. Given the overall inflationary impact of the budget, it can make an impact on the overall consumption. It can impact the profitability of the corporate sector if they are not able to pass on that cost. We need to wait and watch on that. In next couple of days, since the budget event is behind us, we saw the presentation of railway budget and the monetary policy. So these were some of the significant events that market was looking to. We have witnessed a rally in equity market since the beginning of the year on the back of flows from foreign investors and also incremental positive change in the domestic economy. Going forward, we think that in case the monetary easing done by European Central Bank, Federal Reserve, Bank of Japan and other central banks continues, then flow of money to risk assets like Indian equities would continue, and that will support the market. At the same time, concerns about the slowing down of the domestic economy, concerns about the persistence of high inflation and higher interest rates, which also are impacting the corporate profitability, that may persist. Budget has not provided a major hope to the market in terms of addressing the issues which the corporate India has been grappling with. The policy paralysis or the execution failure, whatever we call it, but the corporate India has been dealing with a difficult situation over the last couple of quarters. We expect that some of the measures that have been taken in recent past, the government will take some more measures to boost investor sentiment, and particularly in the areas of infrastructure where India has a big need in terms of building infrastructure over the next several years, some more measures would be taken which could be outside the budget. We have seen 2 days back RBI mentioning about the need for fiscal consolidation and augmenting the supply side, which can bring down the inflation, which can give more headroom to the Reserve Bank in terms of cutting interest rates. I think the overall expectations on reduction in interest rates by the Reserve Bank may go down after seeing the fiscal deficit number at over 5% this year. But still, we expect RBI to cut interest rates, though it could be less than what we were expecting a few months back. We also expect RBI to significantly ease the liquidity situation in the banking system, given the high amount of borrowing that they have to manage from April onwards, which could have a positive impact on the short end of the yield curve, and that's why we recommend investors to invest in short-term bond funds, which is rightly positioned to take advantage of those opportunities. Markets would start focusing on other events. We'll have the quarterly earnings cycle from April onwards that market would be looking at in terms of the trends in corporate profitability, the trends in global economy which can impact the capital flows towards India, and also the domestic political and the economic situation. We continue to recommend investors to take advantage of the volatility in the equity market and increase allocation to equities in a gradual manner. Systematic investment planning is the best way to invest. Over a long period of time, equities have delivered decent inflation beating returns, and that should happen over the next several years in India. Given the structural growth opportunity, investors should maintain the discipline of asset allocation. There are interesting opportunities both in equity and the fixed income market. I mentioned about particularly the short end of the yield curve. By participating in the short term fund, similarly in equity funds, the best way would be to invest through the systematic investment planning, since the structural growth story of Indian economy remains very much intact. Net, talking about the union budget, I would say that it would have a neutral impact on the market, talking about the equity market, and will have slightly negative impact on the bond market. As I mentioned in the beginning, that events like union budget lead to higher volatility in the market in the short run, but investors should focus on long-term fundamentals and maintain the discipline of asset allocation. Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.